people who are looking at outbound investment structures. I have with me my colleague partner Keyur Shah. Keyur heads the FS tax practice for entire India, and he has over 25 years of experience in tax, specifically on financial services, and also looks at the regulatory side on the FS sector as well. With us, we are privileged to have Mr. Pawan Shah. Pawan sir is the division chief for policy division for investment funds at IFSCA. He's worked, he's worn various hats at RBI, SEBI, and now with IFSCA, with more than 2 decades of experience in financial services sector. And with us, we have Ritesh Kumar who is an AGM at International Exchange IFSC Limited. He again has over 2 decades of experience. So, we have a good combination of panel members over here. So we have a representation from the regulator. Pawan has been on the committee that was set up to roll out the fund management regulations at IFSC. So we'll have good insights directly from the regulator in terms of what were the discussions that happened at the committee level, how they've been incorporated in the new regulations that came out in April, and what's the future plan. So we'll have some insights from Pawan, as well as we have Ritesh from the exchange side. So he'll tell us at the IFSC exchange side, what are the activities that are happening, what are the opportunities for the entire FS ecosystem, for PMS managers, for AIF managers, as well as for the investors as well, HNIs, institutions who want to participate in the IFSC ecosystem. So let me begin with handing over to Pawan sir to give us a quick snapshot of what is his view in terms of the IFSC ecosystem, what he's seen at the ground level. So over to you, Pawan sir, to take us through your views.
Thank you so much, Jaiman. Thank you to India Annex and ENY both for organizing this webinar. Probably it could not have been at a better time actually. On 1st of October, we would be completing 2 years since our foundation actually. And during last 2 years, a lot of water has flown, a lot of regulations we have notified in certain areas, certain activities have started. So it's a good time to just review specifically with respect to the entire set of activities under the fund management. It's a good time to look at what we have done and what is the kind of business traction that has started. So I'll just share my deck. Hope it is visible. Hello.
Yes, sir, we can see your screen.
Perfect. So just in terms of what I would like to cover over the next 15 to 20 minutes would be about just in a couple of minutes about IFSCA, about our role. What is this area which has been notified as GIFT IFSC? I'll also share with you the regulatory background, what were the earlier practices, why there was a need to change the regulatory framework for funds in IFSC, what is the current setup for fund managers who intend to set up their operations in IFSC, just an overview, and then probably details maybe ENY can cover in their presentation. And at the end, I would like to share with you as in the areas which we are currently examining and what all you can expect towards the areas of fund management. So to start with, IFSCA has been established as a unified financial sector regulator by the Government of India. It has been established under an Act of Parliament, and it's a regulator which is a special regulator with powers under 13 central acts. No other regulator in India has so much power under so many different acts. So for the purpose of regulating and developing financial products, financial services and financial institutions in IFSC, the IFSC has been vested with the powers of all 4 domestic sector regulators, that is RBI, SEBI, ADA and PFRDA. So I already mentioned about the powers that we can exercise under the 13 central acts. In terms of the GIFT city, so just to share with you the entire construct, the GIFT city area in Gandhinagar, Gujarat has 2 areas. One is a domestic tariff area where a lot of activities not just related to financial markets, other than financial markets, can also take place. And then there is a special economic zone. The GIFT Special Economic Zone has been notified as the maiden International Financial Services Center, and so far the only International Financial Services Center in India. So this particular area, the GIFT SEZ area, enjoys certain special powers. And apart from the tax part, which probably ENY would cover in greater detail, at least one area which I thought I'll share it with all of you is the entities which are set up in GIFT SEZ are essentially enjoys a non-residency status under FEMA. So the larger capital controls which are normally applicable in India are not applicable to entities which set up their operations in GIFT IFSC. So once you set up your operations and once you have your fund structure, once you have money lying here, it's easily convertible. There are no limits to overseas investment. So all of it is not applicable. In terms of the developments at IFSC, I don't want to go through the entire story of the banking ecosystem, the insurance ecosystem, the capital market ecosystem, but I can tell you that all of it is present. We have enabling framework for various kind of activities. To get into some of the specific recent developments which have taken place in last 3 months, I would say, one, I would say you would have read the Honorable Prime Minister of India has launched the India International Bullion Exchange, which is the only spot bullion exchange in India. Through this exchange, it is as in the entire bullion which is now being imported into India, the exchange becomes an important gateway for importing bullion into India. For years together, India has been as in one of the largest consumers of gold, and we are not in a position to influence the global bullion prices. But with the setup of this exchange over the long term, we definitely expect India to be a price influencer in the global bullion market. Another important development that took place in August 2022, IFSCA as a regulator became a signatory to IFSCO Multilateral Memorandum of Understanding. So this opens up dialogue and exchange of information with more than 125 countries. Just a recent development which happened day before yesterday, we entered into a definitive agreement with Monetary Authority of Singapore for collaboration in the area of fintech. Through this agreement, we see a lot of Singapore fintech setting up their operations in GIFT IFSC, and in the same manner, we also expect a lot of IFSC fintech setting up their operations in Singapore. In terms of specific capital market activities and data around it, in a period of last 1 year, we have seen more than 32 investment funds registered with IFSCA with a total commitment exceeding $6 billion. The exchanges in IFSC have clocked an average daily turnover of more than $14.5 billion as compared to only $3.4 billion before a couple of years. In terms of banks, we have large presence of domestic as well as international banks setting up their operations in IFSCs. Some of the branches of Indian banks, their asset sizes are larger than what it was in any other foreign country where they were present. In terms of total asset size, they've exceeded $33 billion as compared to $14 billion in September 2020. And one area which is close to our heart is various products related to ESG. And at least the ESG linked debt securities, we have seen a listing of securities worth $7.3 billion on the exchanges in IFSC. Coming specific to the fund side of business that we have enabled, and before we get into what we did with respect to the fund business in IFSC, just to share with you the past practice and how the entire jurisdiction has developed as a jurisdiction which is now being looked as a favorable or a preferred jurisdiction when somebody is looking to set up a fund in an overseas jurisdiction. So before IFSCA took charge in October 2020, the domestic regulators were in charge for various financial sector regulation for IFSC. With respect to capital market and funds, SEBI was the regulator who was in charge of developing and regulating IFSC area, and naturally, as in the SEBI AF regulations, which was already in place, was extended for funds who intended to set up their operations as a AIF and IFSC. After we took charge, there were certain representations made where it was mentioned that when we compare it with other developed financial centers, certain norms on leverage or probably on diversification required to, as in we should revisit. That was the suggestion, and then we actually did a comparison, and we felt like any other developed financial centers, we should permit leverage with certain disclosures. Same way, diversification norms were exempted for funds which were looking to set up their operations in IFSC. Again, we enabled relocation of funds which were already set up in certain financial centers, and the government and various other regulators were kind enough to extend a few things to enable the relocation of funds which were already set up in other jurisdictions. With respect to manage accounts or advising individual client accounts, largely again SEBI PMS regulations were applicable in IFSC. After we took charge, we came out with a specific regulations for various activities related to capital market intermediaries. And then portfolio management services was also considered to be an important activity and included in the IFSCA capital market intermediaries regulation. With respect to private placement and public offer of various investment trusts, we came out with a framework by way of circulars. And while SEBI had issued broad guidelines for setting up of retail funds, essentially the mutual funds and ETFs, the detailed operating guidelines were not issued. So if you look at the larger set of fund management business, when I say larger set of fund management business, it includes institutional funds, it includes retail funds akin to a mutual fund, it includes ETFs, it includes portfolio management service. Essentially, we see all of it as a single activity where you are trying to deal with clients' money. So we find that there was not a unified approach in the entire fund management business. Again, when we compared ourselves with some of the international financial centers and their practices, what we observed was there was a unified approach towards the entire business of fund management. And again, from the entity's perspective, who intends to set up their operations in various activities related to fund management, this would not lead to ease of doing business. They'll have to refer to different regulations. They'll have to approach the regulator at different points of time under different regulation. They'll have to go through the due diligence each time when they start a new activity. So we felt that there is not, as in, there is a need for a unified approach. Let's review the entire regime for fund management. That's where we constituted an expert committee with market participants. We invited a lot of overseas market participants to make a presentation to share their thoughts, their ideas with the committee members. And one of the largest thing that was discussed and deliberated in the committee was between registering and regulating the fund vis-a-vis registering and regulating the fund manager. We at IFSCA right from day one were convinced about moving to a regime where we start registering and regulating the fund manager. We felt that from, at least from our perspective, it gives us a direct oversight over the fund managers. In terms of the entities who want to set up their operations, this would definitely lead to ease of doing business, while they'll have to go through a one-time process of registering the fund management entity. But once they are registered, their launching of funds, as in, it would be very quick. The time to market could be reduced. For certain kind of funds, once they file it, they can immediately open for subscription. For certain activities, again, they need not even intimate the regulator because they already have an umbrella license to carry out various fund management activities. This was again in line with global best practices. And lastly, as a regulator, in terms of our supervision and even from the entity's perspective, rather than each particular activity being supervised in silos, what we thought was this would give a good way to have an overall supervision based on the total amount which is being managed by the entity, the kind of investors that they are advising and managing, and the kind of schemes, whether it is more of retail oriented, whether it is more of institutional business. So overall, we can, our supervisory approach can depend based on the various activities that the fund manager will undertake. Based on this, what we did was we came up with a regulations in 2022. It was notified in August 2022, where under a single license, the fund management entity can undertake a host of fund management activities. when I say a host of fund management activities, this would include starting a retail fund, starting an institutional fund, which is akin to an AIF in India, can also advise and manage individual clients through a portfolio management services. The same fund manager can also manage and advise, as in can also assist in public offers of REIT and InvIT. Same manager can also handle private placement of REIT and InvIT. So a lot of things we have enabled under a single license. While we also appreciate that certain fund managers would like to do only institutional business and may not like to take money from retail or would avoid doing retail business. So then we have a separate category of license which will have lower oversight, lower regulatory requirements, and that's the second category under which the fund management entities can seek their registration, which is registered FME non-retail. The all-encompassing license, the registered FME retail. So essentially, these are the two license categories, and the third piece, which is a very small piece of license, we have just enabled for two sets of activities. One is VC funds for investing in startups in a quick manner. Here, the amount of oversight would be least. Entities would be in a position to take money only from investors less than 50 and above a certain threshold, and they'll be investing essentially in Indian startups. The various schemes that we have enabled, which I have already highlighted, retail schemes which are akin to mutual funds. We have restricted schemes which are akin to domestic AIF. All these three categories under one particular regime of restricted schemes. In terms of other activities, I have highlighted, we have enabled public offer and private placement of REIT and InvIT. We have also enabled registered FME retail as well as non-retail to undertake portfolio management services. In fact, all three categories of FME, we have enabled them to advise and even launch self-managed family office fund as well. In terms of certain other innovations, what we have done is, while we wanted to ease out the entire process for established fund managers, even for the aspirational fund managers, we have a concept of fund lab, where new fund managers can try out different strategies in a controlled environment, and then probably once the strategy has been tried, tested, and we are fine with it, they can take it to the commercial launch. We have enabled a SPV structure for leverage and co-investment. Even in case of retail schemes, that is the mutual funds, we have allowed investments in unlisted space to permit to a certain extent of 50%, so that even the entire public at large can benefit out of the entire growth story of the unlisted in the unlisted space. In terms of other focus areas of IFSCA, which I'll probably talk in later part of my presentation, pertain to ETFs, ESG, and stressed assets. Again, we understand while fund management will take off and it will find its own ways, as in terms of the entire jurisdiction, we would also need certain set of ecosystem for funds to thrive in this area. That's where now we have already enabled fund administrators, trustees, fund accountants to set up their operations in IFSC, and now they already have their presence in IFSC. I'll talk about a framework for accredited investors and distributors at the end of my presentation. So these three categories I've already talked about. The only is in a small clarification, which again I'll make, is authorized FMEs will be in a position to undertake all activities which a registered non-retail FME can do, and a registered retail FME can do all activities which are authorized and a registered non-retail FME can do. And as you go towards the right, which is registered retail, there will be higher oversight by the regulator. I'll just quickly talk about some specific enablers under the IFSCA fund management regulations with respect to non-retail schemes or the restricted schemes that we call, which are similar to the alternative investment funds in India. We have specifically permitted leverage and co-investments. We have also permitted, apart from co-investments by issuing a separate class of units, we have also enabled it by way of a SPV structure. The diversification norms are exempted for institutional funds. Even in terms of the scheme in the game contribution or the sponsor commitment, as you all know, there are certain cases under which we have exempted the scheme in the game contribution, which probably ENY can cover in detail in their presentation. We have separately come out with a framework for angel funds and to share two quick things about angel funds, what we have enabled them is they can come, file the document and immediately open for subscription. It's under a green channel. So you need not wait for a regulator's approval for launching an angel funds. Further, we have permitted angel funds to invest in subsequent rounds as well to protect dilution in their shareholding. With respect to PMS, while we have enabled a host of investment avenues for PMS, what we have also permitted is, let's say if the client is comfortable, you can invest in jurisdictions which permit omnibus structure and you need not have a separate client account. In case of a PMS account, if client is okay and the jurisdictions recognize such omnibus structure. With respect to exchange traded funds, in addition to the standard passive funds, we have enabled active ETFs. We have also enabled launching of secondary, as in we have enabled joint listing of ETFs as well as secondary listing of exchange traded funds on the exchanges in IFSC. In terms of benefits of setting up operations in GIFT IFSC, I think ENY in any case would be covering this in greater detail, so I can skip it at this point of time. Some of the future areas I'll probably spend a minute or two here. So one thing which we are very clear in our mind is we want to have a consistent approach in our regulation. We would not want to have frequent changes in our regulation. If you look at our regulations, we took some time, we had a wider consultation process, and once notified, there has been some stability to the regime. So now what all we would like to do would be in addition to what has already been notified. One area which we would like to do is in, you would have probably read or heard, there was an expert committee which was constituted and had recommended variable capital company structure for funds in IFSC. Now there is another committee which is examining in greater detail how can this kind of structure be enabled for funds in IFSC. While probably this will require larger changes in legislation, we are conscious of this fact. Along with the committee, we are trying to see how best we can do it for the funds in IFSC. Under the fund management regulations, we already have certain exemptions which have been carved out for accredited investors. We are yet to notify a framework for onboarding of accredited investors, the eligibility requirements of accredited investors, which we are examining, and the whole point which we are trying to see is how can we ease out the entire process. So we are trying to see some of the practices. Is it possible? Can we look at practices where rather than centralizing the entire operations of onboarding accredited investors, can we look at areas where the entities themselves can look at investors and see whether the investor is accredited investor and onboard the investor? Can we also look at certain jurisdictions with whom IFSC is comfortable and which have a robust mechanism for accrediting investors? Can we take investors recognized on those jurisdictions as accredited investor is another thing which probably we are looking at. But again, this is under examination stage and probably with pros and cons, we'll try to figure out. But the entire idea is to ease out the entire process of onboarding the accredited investors. And already I mentioned that the carve-outs are already in place under the regulations. I mentioned that ESG is one area which is close to our heart. You will find a lot of there is a separate chapter for schemes pertaining to ESG areas. This is one area which we are trying to see what has been prescribed by certain other regulators, certain other jurisdictions which are known for having a lot of fund management business towards the green space, and probably will have different set of requirements for such schemes. And in fact, we would in any case we have incentivized the early adopters of this kind of schemes as well. And the last piece is, while we have enabled fund administrators and trustees, we also feel the distributors of financial products and services, including funds, will play an important role in taking those funds to the end investors. And we are looking at a framework wherein we can enable certain set of entities to distribute the financial products and services to the end investors. Before I conclude my presentation, I just would like to share what the vision for IFSC and IFSCA that has been laid out by the Honorable Prime Minister of India in his recent visit to IFSC. In his own words, IFSCA will become an enabler. It will support innovation and also become a catalyst for growth opportunities. With respect to the GIFT IFSC, he mentioned that GIFT City is an important gateway to get connected with India as well as global opportunities. When you get integrated with GIFT City, you get integrated with the entire world. With this thoughts, I'll conclude my presentation, and probably with some time left at the end, along with my fellow participants, we can take few Q&As at the end.
Thank you, Pawan sir. I think this was really insightful. Lot of points that we noted, in terms of accredited investors or ESG, and even, IFSC is thinking ahead in terms of framework for distributors as well. So I guess, a lot activity happening, for our participants. You can put your questions in the chat window. We'll take them towards the end. But sir, I've been tracking IFSC, and every month there is some new notification circular. In the last since IFSCA has taken over the regulatory framework, and all of these regulations are really path changing. Be it foreign universities which came up in budget, sustainable finance, fintech incentive scheme which just came 2 weeks back, FME regulations, and even the time between the committee's report came out in January, and we had the final regulations in April. So I guess, we are seeing IFSC authorities very, very active in this space. And personally, we've done a lot of representations on a lot of these spaces. And our experience has been that, the regulator is always, open to hearing suggestions, taking a practical view. And as you alluded to, sir, the regulator is always looking at global best practices. The horizon is very broad in terms of, how do we place GIFT IFSC, in the global map. It's not just about, looking inward just for India purposes, but this is a global platform for making inbound investments as well as outbound investments. So very, very useful points that you made in your session. Sir, what I'll do is that I'll hand over to Keyur now, who's also been active in the IFSC GIFT space, and he can cover generally, what are the tax and regulatory key incentives that IFSC provides.
Thank you, Jaimin. So
Thank you.
I think before we start, one point which sir also made, I think the biggest change which we have seen and the biggest amount of traction we saw in the whole GIFT City ecosystem and the IFSC ecosystem was when the IFSC authority got set up. I think the fact that there is now a single regulator which looks at everything which has to do with IFSC investments and regulation, I think is a huge change, and I think has brought a lot of comfort to investors in terms of why they should have a IFSC presence. And the fact that all the rules and regulations governing entities which are based in IFSCA are made by the IFSC authority is a significant amount of comfort which one gets. So that is one point I wanted to highlight. In terms of just the kind of people who have set up base there, as sir mentioned, there are 32 AIFs, 5 PMS entities. Even from a banking perspective, we've seen a lot of banks, while all of the PSU banks would have a presence there. Many of the foreign banks also have set up a presence there, and we've put a few names here which are also available on the IFSC website. But just to mention the likes of Citi, Barclays, State Bank of India, HSBC, Deutsche, even within the broking community, the likes of Phillip Capital, etc., are all present there and have been actively trading there. Going to the next slide. In terms of opportunities, I think clearly the amount of work the regulator has done in covering the full financial services ecosystem is phenomenal. Whether it is from a banking presence, from an insurance perspective, capital market, asset management, and all sorts of emerging areas like aircraft leasing, fintech, as sir was mentioning around, having sandbox regulations for fintechs, having a fintech hub, treasury centers, bullion exchange, ancillary services, education. So a whole host of regulations are there to create a appropriate ecosystem for entities operating there. One point which Jaimin also mentioned, and I cannot reiterate more, is the fact that this regulator, to a great extent, has been, it's like a breath of fresh air dealing with the IFSCA regulator, because they are always willing to have a conversation with the stakeholders to understand what their difficulties are and figure out how we can create a conducive business environment so that the regulator is acting as a catalyst to grow business within that zone and not acting as a hindrance. So that is, I think, one of the biggest achievement to date, I think, of the IFSCA regulator in just attracting business. Going to the next slide. In terms of the fiscal incentives, yes, we have a 10-year tax holiday. It is the only zone within under the Income Tax Act where you still get a 10-year income tax holiday. There could be MAT implications if you set up a company there, but there could be some planning around that to reduce that. There is exemption for non-residents investing into funds set up in IFSCA. Plus, from an indirect tax perspective, also there are significant incentives. There is no GST applicable because this is an SEZ zone. Plus, there is a host of incentives which the state government has put through under the Gujarat IT policy, which also enables setup of largish entities in the gift city, largest in terms of having large number of employees. And those we can again at some point in time go through in greater detail, but significant amount of state incentives are there. There is no stamp duty again because it is in an SEZ zone. Plus, there are a host of corporate law relaxations also, like for example, there is no CSR contribution requirement, etc., which is there within the IFSCA zone. Going to the next slide. In terms of strategic advantages, again, one obviously is, as I said, I think the regulator being the catalyst of growing business there, I think is the biggest strategic advantage. Obviously, availability of talent, because from a university perspective, Gujarat has had a host of university which churn out a lot of engineers, BCom, CA, etc. To a great extent, Gujarat has been an exporter of talent, but once the hope is that with IFSCA, a lot of export of talent will get curtailed and a lot of people would want to stay back within that zone. Obviously, real estate is cheaper compared to if you're looking at setting up a larger space with a lot of employees and needing a lot of space compared to many other zones where you end up seeing captive centers being set up like a Bangalore or Hyderabad. Real estate is better. Also more, it's just the quality of infrastructure is better. Not only is it cheaper, also they are promoting a work from home, walk to home concept, whereby most of the infrastructure is close to work. So again, if you have to end up traveling, etc., there is a whole host of residential infrastructure which is getting developed there. So I think that is what it is. I think I will go to the next slide. Jamin, you want to cover fund management activity?
Yeah. So, so we have two sets of regulations which we are covering here, basically under one framework, which is FME framework. But broadly, we can look at two structures, from a fund management or portfolio management or wealth management perspective. One is we look at a pooling structure, right? Whereby you pool the money of all investors and you invest like a private equity fund, right? That's what, it's covered under this slide that we can see, where you register as a fund manager and then you can launch different types of schemes. Second is a scenario where you manage segregated accounts for each client, right? For HNIs, for individuals, for NRIs, and you manage each client's account differently. That's under the PMS regulations. So broadly, we are breaking up this conversation into two parts. One is a pooling structure, and second is a segregated structure, which will cover under PMS regulations. Now, some of the points, Pawan sir already covered in the slide, but here the unique feature to note is that the fund manager is regulated and not the fund as such. That makes things easy because, every time you need to launch different schemes, you just need to file a prospectus and seek approvals or wait for the time to expire for the regulator to revert on. So interestingly, you just need one-time detailed license, and then every time you launch the scheme, it's a very easy process for you to go through. Second, on the right hand side, we can see, we have unique things over here in terms of ETFs, PMS, investment trust, family investment funds. We'll try to touch upon some of these things in the latter part of our session. And we have different types of schemes. So let's quickly jump on to, very quickly, what are the regulations, or, why this scheme is attractive, or, why is this an important, or, why does it attract, domestic managers as well as global presence. So one is that, you can use IFSC as an offshore presence. What it means is that, FEMA is not applicable in IFSC. It's treated as a non-resident zone from a FEMA perspective. So any activity done in IFSC, it's deemed to be done in a foreign territory from a FEMA perspective. And that's why it's easy to pull money from offshore, investors. You use it as a feeder or as a master fund, either ways you can use it. You can also use this vehicle to make investments in Indian AIFs or global funds as well. So you can do different types of structuring around this. I think the point to note is that, you get a lot of freedom from a FEMA or non-resident perspective. Second is that, I can see there's a question from Raj Gopal. What are the incentives? We'll cover that in the next slides. But, the interesting to note is that, historically, a lot of fund managers have set up pooling vehicles in Mauritius, Singapore for inbound investments, right? And even for outbound investments, people have used jurisdictions like Cayman, BVI, London, US, some of these jurisdictions. Interesting point to note is that IFSC now provides an equally attractive framework, or even better from a lot of aspects compared to Mauritius and Singapore treaties. So that's again a point to note. We'll cover that in the subsequent slides. And obviously it comes with, a lower cost of operations as well, compared to some of these centers which are mentioned in point number 2 over here. Point number 3 is that, unlike many regulatory frameworks in different countries or even in mainland India, in IFSC, there are flexibility in terms of leverage, in terms of co-investment or setting up an SPV structure, as well as investment diversification norms as well, compared to, many jurisdictions or even in mainland India where 25% cap is applicable. We'll cover this also briefly in the next slide. Fourth point, like Keyur mentioned, there is an income tax holiday. So a manager who sets up an office over there earns management fees, gets a full 10-year tax holiday from income tax, as well as GST is not applicable on that management fees. Fifth point is that, for overseas investments, you can use GIFT as a platform. Indian investors can, can remit money through LRS route in GIFT, and from GIFT, those investments can be made out of India. And yeah, fifth point is that, GIFT has a lot of innovative solutions. Like Sir mentioned, it has innovation lab. You can use it as a testing vehicle, and more things to come up. But let's quickly jump into specifics, of what are these regulatory frameworks. So if you are an individual or a financial services player in mainland India, you are a portfolio manager, you are a fund manager, you are a research analyst or an investment advisor in India, then these are the 3 broad frameworks under which you can set up a FME or a fund manager entity in GIFT City. And let's look at some of these details in, so first is, how do you decide which license to take? Should we be an authorized FME, non-retail or retail? Like the name suggests, and the first bullet is important. If you want to set up funds which are focused only on venture capital investments, or an angel fund or a family investment fund, and we've covered these definitions in the subsequent slides, then you can be an authorized FME. The point to note is that, you only need 1 minimum KMP over here, unlike the other ones that you can see in the 4th bullet. If you are a non-retail, you need 2 and 3 people. So authorized FME, very simple framework. With 1 employee, you can pretty much start your office over there. Obviously, you need to comply with the regulations, fill up those forms, get a license. But from a manpower requirement, you need 1 person KMP over there. The regulations specify what are the criteria for this 1 principal officer. Plus the net worth also is lower compared to the other 2 frameworks. $75,000 is the minimum net worth that you need. If we directly jump to the retail one towards the right hand side, there you need 3 people. You can launch retail schemes, which are very similar to, mutual funds that we have in India. There are criteria in terms of, minimum investors, minimum contribution, where you can invest, but as comparable to our mutual fund sector. The middle one, the non-retail one, is comparable to a typical AIF that we have in India, or a typical PE fund, which is neither retail nor authorized, somewhere in the middle. The point to note is that you need 2 minimum people to set up this office. You can set up a branch, you can set up a company or an LLP. The only condition is that if you're setting up a branch, then you need to be regulated somewhere, either in India or outside of India. KMP is, key managerial people. So that's the condition, for 2 people or 1 people or 3 people that you need in IFSC. So if you are an existing investment advisor, fund manager, or a portfolio manager in mainland India, then you can even set up a branch. Very easy to set up. You don't need a separate legal entity, and through a branch structure, you can start your operations in GIFT IFSC. That's not applicable to the retail category, because retail, you are dealing with large number of investors, so you need a separate legal entity in IFSC to set up and commence your operations. We can move to the next slide. Yeah, some more details about the different types of schemes that these managers can launch and who can launch. So venture capital schemes can be launched by FMEs. There are criteria in terms of what can be the minimum contribution per investor that we can see here. For VCC it's USD $250,000, for restricted it's USD 150,000, and for retail accordingly. Similarly, as we can see on the screen, how many minimum and maximum investors you can have. So across schemes, very clearly the regulations prescribe the number of investors. Similarly, where you can invest, right? So permissible investments, very, very broad. It pretty much covers different types of instruments, from debt, preference shares, units, mutual funds, shares, securities, very, very broad. I feel it's very, very exhaustive in that nature. Similarly, there are conditions on, depending on the type of scheme, how much you can invest in unlisted stocks or listed stocks. So pretty much very, very comprehensive framework. I'll not get into the specifics of each of these schemes and each of the fund managers, but basically I think one needs to keep in mind 3-4 things to evaluate what kind of manager you want or what kind of scheme you want to set up. One is, where are your investors from, right? So do you have domestic investors? Do you have foreign investors? Do you have high ticket investors, or do you have retail investors, right? That's the first part that one needs to answer. Second is, where do you want to make investment? Do you want to make investments in India, out of India, within IFSC? Those are the jurisdictions that one need to decide. You can invest in multiple jurisdictions as well. That's also a flexibility that IFSCA provides. And third is, what kind of instruments and investee companies that you want to invest. Do you want to focus on listed space, unlisted space? And second is, what kind of instruments do you want to focus? Do you want to focus on derivatives, equities, debt, preference shares, GSECs? And GIFT also provides avenues for non-securities as well, like real estate avenues as well. So these are various factors that one needs to keep in mind. Your investors, investments, instruments, and depending on that, you can first select what kind of manager presence you want to set up, and then under which scheme all your conditions will fit in. So very interesting way in which these regulations are designed. And like Pawan sir mentioned, the regulations are very, very comprehensive. The regulations at the same time are very, very simple, and therefore these provide a very, very stable framework if someone wants to set up an office over here. Can move to the next slide. Yeah. So one is, the size of corpus, minimum, maximum, as we can see on the screen, that's clearly prescribed. Green channel is a very interesting concept, which has been prescribed in IFSC. For VCC type of schemes, there is a clear green channel. So once you have a manager license, you don't need any approval. By filing a prospectus, you can just start with your fund immediately, fundraising. For restricted schemes, again, very, very interesting thing. If you're raising money only from accredited investors, then you directly have a green channel. As Pawan sir mentioned, there'll be guidelines, and they're debating on what's the best practice, or from an ease of doing business perspective, how do they prescribe the definition of accredited investor? That's still work in progress, and we'll see that very soon. Otherwise, the green check, otherwise within 21 days, it's deemed to be approved. Very, very interesting concept. From a timing perspective, a fund manager gets certainty in terms of when do you raise the fund. You don't need to wait for 3 months, 6 months, or a year, to questions from the regulator. Within 21 days, you are ready to set up. Retail schemes, you need a specific approval or a NOC from the regulator. So that's, from a green channel perspective. Leverage is clearly permissible, for VCC restricted schemes. Very, very good and interesting thing, industry friendly as such. And then when you apply for these licenses, you'll also get a specific letter. That's what, and Pawan sir can clarify at the end, that the regulator will give you specific categories that, you fall under category 1, 2, 3. Because, this reference to category is relevant from a tax perspective. Because the tax regulations, were designed for category 1, 2, and 3 AIFs. And that's why, once you get a specific letter, it gives you certainty even from a tax perspective. That, if you are a category 2, you fall under a particular tax framework under the income tax legislation. So that's the broad framework. Let's move to the next slide. Yeah, this is, in terms of sponsor contribution, what is the minimum, maximum? It's all again depends on the corpus, and there are defined percentages that are prescribed over here. But again, it's not mandatory if you get 2/3 of your investors, to get permit you to waive this requirement. So in a way, good for the fund managers. If you don't want to contribute, you can get majority or significant majority of your unit holders get their approval, and you don't need to contribute this minimum corpus as well. Yeah, next slide. Yeah, so a question comes is, who is a KMP? So KMP largely means, a person who is responsible for fund management. And, this is a high level definition of, who the principal officer is, who the compliance officer is, and, what's the role of KMP over here. So, the principal officer's definition is that a person who has, a particular type of degree in financial management, chartered accountant or CPA, as well as a person who has a minimum 5 years of experience in the financial services sector. So one can go through the FMA regulations for detailed definition, but that's the minimum criteria if you want to be a KMP or a principal officer in an FME. And responsibility is that the regulations prescribe that the KMP or the principal or officer is responsible for overall fund management. Now there'll be a lot of questions around on the fact, and Keyur can add more on this point, is that if you are a fund manager in GIFT, how do you practically operate? Do you need to be in GIFT City? Can you travel out of GIFT? Can you take services from your head offices situated, for example, in Mumbai? Can people from Mumbai travel over there? Can they be on the board seat of the fund manager entity in GIFT? So Keyur, you want to give some comments on that?
Yeah, I think that again, the regulator has been fairly forthcoming on this. The substance requirements within the regulations have been very crystal clear in terms of, as Jaimin highlighted, in terms of what you need from a KMP perspective. Having said that, the regulator is also aware, and like any part of the global fund industry, that all the people who are managing the fund, like your investment committee, cannot be based out of the GIFT City. So to that extent, you can have an IC which is predominantly based outside the IFSC zone, which can take decisions on the investment go no go process. Also, to a certain extent, if you need people who are going to be marketing the fund, for those people, they could be based outside the GIFT City or GIFT IFSC zone, because their role predominantly would be to market the fund and to get subscription for the same. So that is how we've seen some of the funds getting set up. Obviously, one does need to remember that you are going to seek a tax exemption for 10 years for your fund management entity. And therefore, to that extent, getting the right level of substance in that entity in terms of the kind of to ensure that the decisions with respect to all the fund management activity are made by that entity are going to be critical. So it is important that you get appropriate advice on this issue before you implement a particular structure.
Thank you, Keyur. So No restrictions on people or employees of IFSC to travel out of IFSC. I think that's a common question that we get from everyone. However, those employees have to be primarily employed and housed in IFSC. But for work purposes or business purposes, for a portfolio manager, it's very normal to travel and meet the investee companies, at their offices, meet the promoters. All of those things are clearly permissible. You can travel outside for distribution of your fund, meet investors. All of those things are good.
And today also, as we speak, even for the offshore funds, the portfolio companies, if they are based in India, they would have people who are present across the board who would be on the board of those portfolio companies or visiting those companies. And I think that the regulator understands that that is something which is required and can be done.
Yeah, moving to the next slide. So let's look at some practical scenarios or live case studies, where people can set up, an EIF in GIFT. Now, this is a very typical structure whereby you have foreign investors in GIFT AIF. And for simplicity's sake, we've taken category 3 AIF, which is permitted to invest in listed securities. And Cat 3 AIF, as we can see in the table over here, Cat 3 AIF, GIFT AIF has concessional tax regime under 1040 of the income tax law. And if you can see in terms of exemptions it carries in the table which is mentioned here, capital gains on other securities, which basically means debt and derivatives, is completely exempt from Indian tax. So if you have foreign investors, if you set up a category 3 AIF in GIFT, which invests in securities in India, it invests in securities in IFSC, or it invests in securities outside of India. So all those three jurisdictions, so to say, can be exploited. You can invest in an AIF in India as well. So that is also permissible. And we can see, for interest and dividend, there is a concessional tax rate of 10% as well. If you look at many of the India's tax treaties, they provide concessional tax rates of 15% or 10%, but they come up with their own riders. One needs to comply with all those conditions, LOB conditions or limitation of benefits conditions of expenditure test, minimum substance test. Then only you can avail all these conditions of 10% and, exemption on capital gains on debt securities. While in IFSC, it's encoded under the domestic law itself. So, you don't need to go through those treaty conditions and, live in an uncertain environment to claim these concessional tax rates or capital gains exemptions. In IFSC is encoded in the domestic tax law. We saw minimum, manpower requirement prescribed under the IFSC regulations. That's the minimum conditions. Other than that, there are no conditions as such. So very interesting framework on the tax side as well as regulatory side. You set up a pooling vehicle. The left-hand side box is the manager entity in IFSC that manages the AIF. AIF can be a trust or an LLP, which will invest in various places, in India, IFSC. And that's how you can run this entity over there. So this is one typical structure. We can move to the next slide. So now let's move to the PMS structure. This is more, where you can have separate accounts for your clients. You don't need to pool money in an AIF. You can have different types of schemes for your individual investors, manage their investors separately. So one is just a point to note is that PMS also falls under FME. I think one of the questions that was posed is, where does PMS fall or where does mutual funds fall? It's not called as mutual fund, but there are retail schemes under FME regulations itself. Similarly, an FME can also do PMS activity as well. This again can be, point one, can be set up as a company, LLP or a branch. What kind of clients you have, that's very clearly defined. You can have overseas clients, you can have domestic clients, and you can have NRIs as well. But again, point to note is that IFSC is a non-resident territory from a FEMA perspective. And that's why any money that you collect from Indian investors or from foreign investors, especially NRIs, you just need to keep in mind the FEMA framework over there. So the FEMA gets flipped it, when you're looking at an IFSC. The minimum ticket size is 1,50,000 USD. That's the minimum ticket size for a PMS client that you want to manage. So that's a point to note. Permissible investments, again, you can invest everywhere. You can invest in IFSC, in India, foreign territory. you can be a discretionary manager, you can be a non-discretionary manager, all kinds of flexibilities you have. And then you have typical, in point 4 and 5, you need to have your management agreement with the investor. Again, the agreement, very, very liberal conditions are there. There's no specifications on fees, where you can invest, where you can't invest. So a lot of flexibility is provided under the IFSC regulations. But the only condition that I can see over here is, $150,000, which is, at par with, many other countries and other jurisdictions, not a very high ticket size. And point to note is that, FEMA is applicable. If Indian investors want to invest or participate in PMS schemes floated by an IFSC manager, then you need to go through the FEMA legislation as well. But otherwise, very easy to manage a PMS scheme from IFSC.
And also, if you look at outbound investment, when the new outbound investment guidelines have come out, there's a specific section for investments made from India to the IFSC zone. And that is significantly more liberalized than what you end up doing, say, for example, were you making outbound investment in any other jurisdiction.
Yeah. So we'll cover two scenarios or two case studies for a PMS manager. This is a scenario where you want to tap Indian investors. So Indian investors, as we all know, under LRS route can remit up to $250,000 outside of India. So this is a scenario where, the fund manager, the FME in orange box, sets up a PMS scheme in IFSC to make investments. And the investments, those black boxes, can be outside of India or in IFSC. And under the Indian investor, so the benefit it provides is that, this is clearly automatic route as of now. You can you don't need any regulatory approval to collect money from Indian investors who want to participate in global investments. And if someone looks at newspaper articles or global trends, there has been a huge interest by Indian investors to participate in global securities, be it FANG securities in US markets or tech stocks or, European securities, be it ETFs or, those foreign securities. There's a huge demand by Indian investors. And we all know that, there is overall cap on Indian mutual funds and Indian AIFs. I think it's around $8 billion and $1 billion. And most of these limits are exhausted. And therefore, for Indian mutual funds, Indian AIFs, if they want to tap Indian investors who want to participate in global markets, this provides a window, because this $250,000 is per individual. So if you have a family of 4 people, pretty much $1 million can be invested outside of India under this route. And pretty much no approvals are required. FEMA not applicable. The manager's fees is completely exempt for 10 years. No GST applicable on fees charged by FME. Obviously, the individual investors, since the person is a resident in India, they are taxable on their global income. So that continues in normal manner. But yeah, for the fund manager, the fee is completely exempt. The money can be collected and invested outside India. Few points to note is that, why an investor will be interested in this, because you're dealing with a manager in India. Today, under an LRS route, I may have to deal with KYC or, of those foreign jurisdictions, outside of India, in UK, US, where I'm investing. In this structure, an Indian investor is very, very comfortable, because you are working within the Indian jurisdiction framework also only. While IFSC from a FEMA perspective is still, out of India, but it's still Indian jurisdiction. All the Indian laws still apply. You know the person, you are working in that same time zone. You know with whom you are sharing your KYC documents. And if tomorrow you have an issue, you can just go and meet the FME who is sitting in IFSC. So a lot of comfort from a business perspective, legal, jurisdiction, and FEMA perspective in this structure which is there. Very unique structure which is not available in mainland India as such. This is a flip structure whereby the same FME, same PMS structure, but you can tap NRI market. And how it benefits is that, NRIs or HNIs, outside of India, it can be any investors, but HNIs are also there. You can use this money to make investments in many countries. You can make these investments outside of India, in IFSC and India. The point to note is that the Income Tax Act specifically provides exemption for investments made outside of India. So pretty much you are tax neutral So, and you can manage money from, so the benefit here is that you can manage money sitting in India for any type of client, be it an Indian client or an NRI client. And an NRI client, is pretty much tax neutral for investments made outside of India. So, and again, here the fees is also 100% exempt, for 10-year period. So both types of structures are possible. Yeah. High level overview of FEMA regulations. Again, very interesting to note. And like Kioro was mentioning, these ODI guidelines are very, very new. A question comes is that, if I am an Indian resident, I'm an individual or a company or a LLP, how do I go and set up an office in IFSC, right? Because technically you'll be crossing the line. You'll be going from India to assume that it's a foreign territory from a FEMA perspective. And therefore, these recent ODI guidelines which came through, they pretty much give all kinds of flexibility. For an individual, for an Indian company, it even covers a non-FS entity as well to set up an office in IFSC. So very quickly, to go through some of these ODI regulations, non-FS entity currently permitted to set up an FS entity in GIFT. So for example, if you are a steel manufacturer and you want to set up a treasury center in GIFT, that is permitted over here. So that's where you can have a presence in IFSC. Under normal regulations, if you want to set up an office in Singapore, there are more conditions under FEMA, like, profit track record of 3 years. This is not applicable if you want to set up a treasury center in IFSC vis-a-vis a treasury center in Singapore. So again, a liberalized regime for a non-FS entity. The second one is for FS entities. So FS entities are allowed to set up a presence in IFSC as well as foreign jurisdiction. But again, a very, very liberalized regime. And if you can see the last box over there, there is a deemed approval within 45 days. So I need to go to RBI today if I am a regulated entity, under the banking presence or under NBFC license, which is regulated by RBI. If I'm a capital markets entity in mainland India, like a PMS manager or an AIF manager, I need to go to SEBI and get an NOC. That's what, the gray box mentions over here, that I still need to go to. But the good thing is that, within 45 days, that approval is deemed to be given to you if there is no comment from SEBI, RBI, or by IRDA. So that's under the ODI framework. And just to remind everyone, we are only talking about an ODI framework. We are not talking about the IFSC license and regulations, which we've covered in the first slide. So dual approvals are required. One is, when you cross the line, the ODI framework or the FEMA framework is applicable, and the conditions are applicable depending on you are an FS entity or a non-FS entity. So here currently we are talking only about the ODI framework. The third is, where any Indian entity wants to set up, a manager, or, you want to make a contribution in an investment fund. That's also clearly now explicitly permitted under the ODI framework. Individuals in India can, or a sponsor as a manager, you can contribute to the AIFs in GIFT City or an investment vehicle. Last is, LRS is very, very clearly, prescribed or clarified now that you can invest under LRS route. Resident individuals can set up and can set up an entity or an LLP, under this $250,000 limit, which is there under LRS. So even from a FEMA perspective, there is ease of doing business. If you want to set up any kind of entity, branch, presence in IFSC, obviously, this is only a high level summary that is there on the slide. There are some more conditions if you go through the recent ODI circular which came, which was issued by the government. So I'll pause here. Basically, to summarize, we've covered fund management regulations for pooling vehicles like alternative investment funds. There are concessional tax regimes, for dividend and interest earned by that pooling vehicle, which is 10%. Capital gains on debt is exempt for that pooling vehicle. You can collect money from various investors, be overseas or Indian, and invest in various kinds of securities, be it listed, unlisted, outside of India, in India. At the same time, you also have an option to manage investments under the PMS license as well. Again, invest in India, outside India, manage client money. The minimum condition is that, you need to collect money per investor, $150,000. So lots of opportunity for different types of players. if you are an Indian PMS manager, want to attract your HNI clients, NRI clients for overseas investments, you can use this window. We have Ritesh from INX who will cover, how INX provides this ecosystem to these PMS managers, right? For overseas investments, because BSE through their exchange has set up a network and franchise, which connects to overseas brokers. So very interesting thing, Ritesh will talk more on that. So we have the regulatory framework, we have the FEMA framework, and we have the exchange enabler as well. So how do I connect to the overseas markets, for my foreign investments? So I'll hand it over to Ritesh, who will cover in terms of how do I practically make these investments in foreign investments. So Ritesh, I'll hand it over to you.
Yeah, thanks, Jamin. So, good evening, participants and dignitaries. Thank you for joining in today's webinar and giving your valuable time. I will not take more than 5 to 10 minutes. So, first, I will give a brief introduction of India International Exchange. India INX or India International Exchange is the first exchange in GIFT City established by BSE, Bombay Stock Exchange, in 2017 and inaugurated by our Honorable PM Shri Narendra Modi ji. As of now on India INX, we have derivative products, good liquidity in derivative products. We have India 50 future, that is Sensex 50, India 50 options of that future. We have gold future, and we have USD INR contract and INR USD contracts. So total volume, average daily volume is more than $13 billion every day. And we have seen a highest volume of $30 billion in a single day on India INX. So liquidity is good, and cost of trading is zero. Like there is no CTT, there is no STT, there is no stamp duty, even exchange transaction charges are not there. So as of now, India INX is having a liquidity enhancement schemes, and we are giving incentive on every trade, a cash incentive on every trade, and we are giving cash incentive on every open positions. So GIFT City entities like AIFs can trade on India INX, as well as the entities can trade on global exchanges, not only on India INX. So we set up that India INX set up a different one more subsidiary in GIFT City, that is India INX Global Access, that was set up in 2018. And what India INX GA did is India INX GA tied up with multiple international brokers, tied up with multiple Indian banks. Now, through multiple international brokers, all major exchanges are available through India INX GA. So India INX GA or India INX Global Access is playing a role of an aggregator, where any entity, a GIFT City entity, need not to go to individually to any international broker. All product, all services are available on a single integrated platform. So more than 150 exchanges of 33 different currencies. Client can trade in 23 different currencies, stocks, mutual fund, bond, ETF, PMS products, even derivatives for non-residents are available through a single integrated account. Can we have a next page, please? Next page, please. Yeah, thanks. So basically, when client go for investment in global market, the cost is a big hurdle. First is the cost of remittance of funds. So usually Indian banks are charging say fixed cost and spread. So fixed cost is around 1,000 rupee. Most of the banks are charging a fixed cost of 1,000 rupee and a spread of around 1 to 2 rupees. Suppose INR USD rate is 80 rupee, then banks are offering a rate of 82 and 78, or 81.50 or 78.50. So each side they are making around 2% when clients are remitting fund online from India for investment in global markets. So we tied up with few banks and negotiated rates and bring down the cost by 70-80%. So for example, ICICI Bank do not charge any fixed cost and spread is 60%. Kotak Bank charge only 200 rupee as compared to 1000 rupee charge from other clients, and I spread not more than 50 paisa on interbank rate. IndusInd Bank 200.5. So just about that cost of remittance. Now the benefit with India Annex GA for benefit for individual clients with India Annex GA is like we are providing stock lending facilities for them. Client can lend stock, can earn income on it. We are providing India Annex GA providing interest on a cash balance in a trading account. So whenever the client is having a free cash balance in trading account, they earn interest of around 1.83% per annum. And obviously the account opening and the fixed cost with India Annex GA for clients, for a retail individual client is zero. There is no account opening fee, there is no annual charges, there is no custody charges or software charges, or so fixed cost is almost zero with India Annex GA. So apart from it, each client is insured by $5 lakh for investing in US market. So this was a brief introduction. We have two entities in GIFT. One is India International Exchange. As of now, we have derivative products, but we are working to bring some equity product also for a vibrant capital market in GIFT City. And the another entity, India Annex Global Access, that provide access of global markets. All major markets, all major products are available through that single integrated platform. So thanks, Janan. Here I will conclude my presentation, and I would like to take questions. Like participant can type their questions in chat box, and even after the presentation, if they have any specific query and questions, they can write to us. My email ID is given on the screen, that ritesh.kumar@indiaanex.com. Right. Thank you.
Yeah, thank you, Ritesh. I think that was interesting to know, what kind of tie-ups and, networks you have created. I think, there are several portfolio managers in India who may have a question in terms of, how do we invest in overseas markets? How do we register with overseas brokers and, exchanges? But I think you have all those things in place in terms of networks, infrastructure, technology, everything. So I think overseas, it's very easy. But let's look at some of the practical questions that we can see on the chat box. And maybe, some of the questions I'll also put it for Pawan sir as well. So maybe I'll first put it, one question is, definition of accredited investor. I think, sir, you touched upon that at the beginning, but any further comment on that?
So essentially, it's a work in progress. In terms of any other jurisdiction, if we look at this is largely defined with respect to income, net worth. Certain jurisdictions have qualitative parameters. So we are looking at all of it and we'll see what fits into our requirements. But essentially, all jurisdictions have similar requirements based on net worth, net income, and certain qualitative parameters.
Okay. Thank you, sir. I think there's a question on what's the cost of setup of the fund structure and, how do we set up? I think there are filing fees in terms of application which have been prescribed under the fund management regulation. But otherwise, one can set up a trust or a company, like you typically set up, because those regulations are same, be it an LLP setup or a company setup or trust. In fact, if you look at the Companies Act or LLP Act, there are concessions provided to an unit in an IFSC. So not all conditions are applicable. So in a way, a simplified corporate or an LLP in GIFT City. But yeah, the MCA remains same, and so pretty much everything you may need to discuss in detail, with your legal team or your tax team in terms of what's the best structure for you. Whether, an AIF or a PMS, and if AIF, then what type of AIF, Cat 1, Cat 2, Cat 3. And then you may need some consultancy in terms of, what kind of things that you need to put in the application in terms of business plan, whether your KMPs are meeting the requirements, those kinds of things that one needs to comply with. But otherwise, very easy to set up a presence, a fund structure, or a PMS structure in GIFT. The question on what is the tax incentive for IFSC investors? Like we discussed in some of the slides, obviously this is not a tax haven. Like, you can't invest in listed stocks in India, through this IFSC and save your capital gains tax. That's not the intention that you provide tax arbitrage. But yeah, if you look at foreign treaties, this is comparable framework. So if you want to invest in debt derivatives for non-resident investors, then the category 3 AIF and GIFT does provide an incentive for those foreign investors. So in a way, very simplified. Plus, those foreign investors are not even required to obtain PAN or file tax returns in India. Unlike a domestic AIF in mainland India may need to do. So to that extent, a simplified framework. If we look at the next structure, I think someone's asked a question on infrastructure and housing and all. I think one can go through the GIFT City's website or IFSC's website. Pretty much, very well developed housing infrastructure. At least I can say, in terms of office infrastructure, there's a lot of development which is ongoing over there. There are already offices. The 2 exchange buildings are there. There are more than, I guess, 6 operational buildings in IFSC, plus in the domestic areas, there are tons of buildings. There is an operational clubhouse over there. There's international school over there, and many more activities happening. Residential wise, everyone knows that this is a city between Gandhinagar and Ahmedabad. So one can stay anywhere in GIFT City, in Gandhinagar, Ahmedabad. It's pretty much equidistance in that sense. Indian banks can provide leverage or limits to set up AIFs in GIFT. Possible. One just needs to see that, FEMA again is applicable. So any borrowing done by an IFSC unit from Indian banks is subject to FEMA regulations. But I think there is enough number of banking presence in IFSC itself, be it foreign banks, Indian banks, and there is one international bank as well. So pretty much if you want to do leverage, you can approach all those banks, borrow in foreign currency. You don't carry any foreign exchange risk, very easy to manage.
What for category 3 fund AIFs? So for category 3 fund AI funds, there will be, if you want to invest in Indian listed entities, you need to set up a entity, again a fund management entity in GIFT, which will then obtain an FPI license, and through that FPI license you can invest in listed securities in India. Set up raise money from Indian investors. The investor. So for Indian investment, so there's a question: can AIF set up at GIFT raise money from Indian investors for the AIF investment into India? If the investor investing in AIF set up at GIFT as an individual, would the LRS limits apply? So there was this whole issue around round tripping till some time back. The RBI has now clarified that to a certain extent. So to the extent of an AIF, which is set up where there are Indian investors, this is something which could be possible. Having said that, we are awaiting detailed ODI FAQs on the ODI guidelines, which should be released fairly soon. And hopefully they'll provide more clarity around this. Otherwise, earlier there was this whole round tripping issue. But hopefully that will get clarified once the FAQs come out. Right now, it seems that it is something which could be doable. But again, the point we must remember is that when you make an investment into an AIF as an Indian individual, the distributions made by the AIF which come back into India would be subject to tax, as Jaiman had touched upon earlier. So there is no tax arbitrage by doing this. Is it real tax? Don't understand this. Is it an AIF offer? an IBU in gift? Yeah. Can an AIF offer units and security to seek leverage from an IBU in gift? If the banking unit is in gift, that answer is yes. Okay. IBU go to.
You can set up a feeder vehicle, which will invest in other AIFs in India. That is possible. You can always set it up as a pooling vehicle or, feeder vehicle.
When you say investment allowed in multiple jurisdictions, does it encompass direct investment in US based funds as well? Yes.
Yeah.
Once you've sought all the approvals, I think investment, whether you are making in US funds also should be allowed. Can IFSC or IFSC fund apply for global exchange or membership program, for instance, FCM or CFTC? So I don't think there is any restriction from an IFSCA perspective to make any application for membership under the FCM or the CFTC. But most of these bodies have their own requirements or regulations in terms of need to be based in that particular jurisdiction. So if you don't satisfy those needs and those requirements, then this will not work.
Ritesh, any comment on this?
Basically, this is the first time we received such query like a GIFT City entity wish to take a membership of any international exchange. So you can take up individually with us. You can contact me on that ritesh.kumar@indiaannex.com. We will discuss it after a discussion with my regulatory team.
I think there are more questions on ODIs and all, but like Keyur said, RBI is coming up with a detailed FAQ. So hopefully they'll clarify, some of these questions which are mentioned on ODI and LRS.
So one question is there, like whether a PAN required for individuals in case of non-resident, like if they are coming, they are EFIs. So PAN is not required for EFIs.
Okay. Also, there's a question that, how are reports to be filed with IFSC authorities? Monthly, quarterly, annually? Is it physical or electronic or frequency?
So we are in the process of having our subtech system in place, and once that system is in place, the entire engagement with the regulator would be through a technology supported platform. But till that time, as in we have that subtech platform in place, right now we have adopted as in we are accepting manually or a scan copy through email. Both are fine.
Okay, that's good to know.
It's only a temporary arrangement, yeah.
Yeah, I think there are a couple of questions on ETFs and family offices, but just to highlight that, the regulations also cover a framework to set up an exchange traded ETF also in IFSC, as well as, there are guidelines on how you can set up a family office trust as well. Very interesting. One of its first kind of regulation for family office trust, which can be set up. Very, very simple regulations. You need to be an authorized FME and you can set up a family office trust. You only family members, and there's a definition of family, can be beneficiaries in the trust. So, lot of overseas investors or, families, especially NRI families historically have set up family office trust in a lot of those countries, maybe for tax reasons, regulatory reasons, but now we have a framework in which Indians can set up a family office trust in the Indian land itself in IFSC and claim all the tax benefits that you otherwise get for investments in foreign jurisdictions. So very interesting framework. If someone wants to set up a family office, for Indians, if you want to set up a family trust over there, obviously you can remit money only to the extent of LRS. But for NRIs and offshore investors, there's no limit up to which, you can contribute money to a IFSC family office trust. Yeah, I think, we are done with our 90 minutes. I think It was a interesting session, and I can see questions getting poured on and on. But you can drop us a line on the email IDs which are mentioned at the below, to Keyur, me, or to Ritesh, and we'll be happy to pick up those questions. But at the end, I would just like to summarize that, overall, a lot happening at IFSC within fund management activity. And, last month, when Keyur and I were in London to meet several global fund managers, to our surprise, everyone was aware about IFSC. The question was not, what is IFSC? Where is it located? I think there were more probing questions in terms of, what next is coming in IFSC. Those were the kinds of questions. There were global investors whom we met, very large ones. They all were familiar with IFSC jurisdiction, similar to Mauritius, BVI, Cayman, Singapore, some of them. So the familiarity is there, the awareness is there. It's a matter of time that, we'll see a good number of investors, institutions setting up their offices in GIFT for global investments. So that's what is happening, and I'll especially like to thank Pawan sir for joining here and giving us valuable insights on evolution of the FME framework in India. And thank you, Keyur and Ritesh as well.
Thank you so
Any
much.
last words, Keyur?
Yeah, just that our email addresses are there. We've already got one request for sharing the presentation, which we will do. So if there is any other specific questions, happy to do a one-on-one call to try and see if we can answer some of those. But thank you everyone for joining the call and making it so interactive.
Yeah, over to you, Ritesh.
Yeah, thank you everyone. Thank you ENY team, and thank you IFSCA, Pavanji from IFSCA, and for all attendees for giving your valuable time. So here we will wind up our session, and for queries you can write down email individually to us. Yeah, thanks everyone.
Thank you.
Bye-bye.
Thank you so much, everyone. Thanks.
Thank you.
Thank you.